Hello and welcome to FT Markets this week. Well, earnings season for the second quarter is heating up, and leading the charge are financials. But financials are not a happy place to be in so far this year if you've been an equity investor. In contrast, if you've bought bonds of financials, you've done rather well. So joining me today to discuss what to expect when a bunch of banks start releasing their latest quarterly results this week is Viviane Rodriguez, who is our FT Markets correspondent. If you're a big global bank that's relying on capital market revenues, I suppose you kind of feel a bit like a Brazilian soccer defender at the moment.
No, that's a low blow. But it is true that bank stocks have been really, lagging the rally that we've seen in the S&P this year. The interesting twist here, though, is that if you are a bond investor, banks have been one of the best investments of 2014.
So what kind of performance discrepancy are we talking about here? How much have you made if you bought the bonds? How much are you looking at having lost if you bought the stock in, say, Goldman or JP Morgan?
Well, some of these stocks, for example, are down, 5-6%. They are underperforming the index, right? Whereas if you buy the bonds, especially long-term bank debt, we're talking about double-digit total returns. So that's really impressive. But you have to remember that in a certain way, what is bad for a stock investor, it's great for a bond investor, specifically when it comes to bank debt.
Right. Now, when we look at some of these big US banks who have a global presence and are very reliant on capital market revenues, one of the overriding themes of this year has been that low volatility, a drop in trading volumes is really hurting their core business. And they're also being pressured by increased regulation. They're also handicapped by the Federal Reserve in how they can return cash to shareholders. They're limited in dividends, how much dividend they can pay. They're also limited in terms of buybacks. So how long does it make sense to stay long the bonds and keep looking at the share price and saying, I don't really want to go there?
Well, it all depends also on how strong the economy is going to perform, how fast interest rates are going to rise. For a bond investor, obviously, some of the things you just mentioned right now are great, especially when it comes to balance sheets. The truth is, bank balance sheets have improved tremendously, exactly for the reasons you just mentioned: increased regulation, higher, lower leverage, you name it. So that just makes it for a very strong balance sheet. So if you're a bond investor, you say, well, this credit quality has really improved, and there's less bank debt out there, much less than it used to be 5 years ago. So there's even a premium in bank bonds, even though issuance has picked up a lot recently. But obviously valuations now in bank bonds are not what they were 6 months ago. They're not what they were 1 year ago. So they're getting rich and getting pricey as well. So if the economy really starts to pick up, as a stock investor, why are you going to put money in bonds if they could potentially, suffer a hit, especially high-grade quality bonds, from an increasing benchmark interest rate? So that is actually the trick on when to make the switch back from bank debt to stocks.
Great, Viviane. Well, thanks so much.
You're very welcome.